Hello and welcome to a discussion that provides an overview of the pension benefit obligation and plan assets of defined benefit pension plans. These are two of the three major components of accounting for pensions. It is important that you view this video before class so that we can learn more together in class. After you view this video, you will be able to state the components that change the pension benefit obligation and the plan assets. You will be able to determine if the plan is over or underfunded. You will also be able to record the first two of the 4 journal entries related to pensions. The pension benefit obligation is affected by several different things. The beginning PBO comes from the last period's ending balance. PBO is stated at the present value, which just means without future interest. It is the amount that would be paid today in today's dollars. The service cost is the cost of employees working one more year, also the current year cost. This is computed by the actuary based on estimated salaries at retirement, how long employees will work and then live after retirement, a discount rate, and other factors that impact how much employees will be paid after retirement. Interest is added to the obligation, since the obligation begins without interest at the present value. As time passes, interest must be added. Interest is computed as the PBO at the beginning of the year multiplied by the discount rate. The obligation is also adjusted for changes in the factors the actuary used to compute the service cost. For instance, a loss occurs when employees are expected to live longer because the company will have to pay more. A gain occurs when salary increases each year are expected to be less, because the company will have to pay less to employees at retirement. Prior service costs occur when the company changes the pension plan in a way that increases the payment to employees after retirement. These changes are normally grandfathered in for prior years worked. The increase in benefits increases the company obligation. The amount is the total amount of the increase to employees. It is possible that changes to the plan could decrease the company obligation, but not likely, because taking previously promised benefits away from employees usually results in a lawsuit the company cannot win. Finally, paying benefits to employees reduces the obligation to pay in the future. The detail of changes to the PBO is provided in the footnotes. The pension trust fund contains the plan assets. The trust fund works just like any other investment account. Beginning comes from the prior year ending balance. The company makes cash contributions to the plan that increase the assets in the trust fund. Payments are made by the trust fund to the retirees. It is important to note that the company does not make payments to retirees. The pension trust fund does. Like any other investment account, the amount increases or decreases by the actual earnings of the funds they are invested. We will compute the actual return by multiplying the funds available at the beginning of the year by the actual percent return. In practice, you just look at the investment statement. The trust fund generally hires fund managers to invest the funds in stocks and bonds. The assets in the plan are used only to pay employee retirement benefits. The difference in the present value of the amount owed to employees, which is the PBO, and the amount available in the trust fund to pay employees, which is the fair market value of the plan assets, is the amount reported on the balance sheet. This is also known as the funding status. The net is reported because this is the part the company is responsible for. The company does not own the assets, so the assets cannot be reported on their balance sheet. The obligation will be paid by the trust fund, so the company is not obligated for the entire amount. The company is only obligated for the difference. If the plan is underfunded, the company will have to pay more because there is not enough in the plan to pay employees. An underfunded situation is reported as a liability. The company has a prepaid when the plan is overfunded and there is more than enough to pay employees. There are 4 journal entries recorded for defined benefit pension plans. The first records the company's payment to the trust fund. This reduces the amount owed for pensions. The entry is similar to any other payment for an amount that is owed. The liability decreases with a payment. The second entry is to record changes to the benefit obligation that are not directly related to the current year. These are things related to the actuary calculation of the total amount owed and any changes to the plan that were related to previous years worked. These impact the cumulative amount owed to employees. Gains and losses from changes to the cumulative obligation are not reported on the income statement because the income statement reports the expense for a one-year period only. These gains or losses are reported in other comprehensive income as part of owner's equity, and a portion is moved to the income statement each year beginning with the next year. A loss is recorded as a debit to OCI, and pension liability is increased with a credit. A gain is recorded as a credit to OCI, and pension liability is decreased with a debit. The amount is the amount that was included in the detail of the change in the pension benefit obligation discussed earlier. We will cover the third and fourth journal entries in the next video that discusses pension expense. After viewing this video, you should be able to determine the change in the PBO and the plan assets. You should also be able to determine if the plan is under or overfunded. You should also be able to record the first two journal entries related to the defined benefit plan. We will continue our discussion on defined benefit plans in the next video. Thank you for being prepared for class. It is much appreciated.